U.S. retail sales really tanked in January. Cold weather, the fires in California, both of those are partly to blame, but more so what Amazon was warning about in its earnings report from just last week. The retail giant said that 2025 is off to a rough start. And what the government reported for retail sales simply confirms what the company was saying. It was across the board weakness too, as even autos, which had picked up during the holiday season, retreated significantly last month. Cars have experienced a small revival, holding overall Christmas spending from really tanking and keeping them at best lackluster. The retreat raises a couple of big red flags, starting with interest rates. And what I mean is, maybe it wasn't lower interest rates which sparked the increase in auto sales. Rather, a whole bunch of people looked at rates and they saw the opportunity to lock in prices before they might soar on tariffs. In other words, even more front-loading demand into late last year that will have to be paid for by retailers and wholesalers and manufacturing, basically the entire U.S. and global economy. That's already what the Federal Reserve reported yesterday with its industrial production estimates. Car production dropped sharply, but overall industry-wide output was only up because of the cold weather, which spiked utility output by an incredible 7% just in the month of January. While that's great for utilities, it isn't for consumers whose heating bills are going to be as incredibly painful as that number is this month. Knowing that, this may partly explain why consumer spending came in so weak in January, as Amazon had warned. It's the combination of more harmful one-off factors. You've got heating bills, you've got auto insurance premiums, as we saw in the CPI. Those are only going to increasingly harm consumers. And behind everything is the Christmas season hangover. Americans want to be generous during the holiday season, but then they have to pay for it at the start of the next year. It all adds up to the same economy which forgot how to grow. Only it doesn't forget all at once, all in a straight line. There are these back and forth. In fact, it's been completely marked by back and forth. It looks like things are going in the right direction, only to, like retail sales in January, suffer an unexpected setback. But in this case, it really wasn't all that unexpected. I mean, Amazon, the retail giant, just last week, here's what the New York Times said. Amazon saw healthy consumer sales and a pickup in its cloud computing business in its latest quarter, but the company told investors to expect slowing growth ahead. Sales from October through December hit $187 billion, up 10% from a year earlier, and profit rose 88% to $20 billion. Both were roughly in line with Wall Street expectations. Here's the thing. But the company signaled that 2025 would be off to a weaker start, expecting sales to grow between 5 and 9% in the current quarter, and that operating profit could be potentially lower than a year ago. And if Amazon hits the lower end of its range, that will be the slowest in its entire history, going back to the late 1990s. The only time that was potentially any slower was in the middle of 2022, amidst the downturn there, when it reported quarterly year-over-year growth of 7.2%. So if it comes in at less than 7.2%, Amazon's putting up a new low. And while some of that is dollar exchange value translating overseas sales back into US dollars, there's weakness there as well as not enough strength in US customers and US businesses to offset that currency translation headwind. In fact, there's headwinds coming from all over the place, which is kind of what Amazon was hinting at. Yeah, they've got AI, that's going pretty well, the cloud business, but their bread and butter consumer segment, the retail segment, is facing substantial difficulties because the overall economy is. But it's January. Retail sales, the Christmas hangover. That means not really admitting the Christmas hangover, but instead excusing it as a product of other one-off or temporary factors like cold in winter. We see this almost every January. We have these big givebacks from the Christmas season in terms of retail spending. What happens is the media says, well, it was really cold and apparently Americans couldn't get out and shop. But they could get out and shop at certain places. It's never consistent. It's not really rational, logical. It's just a way to avoid having to say, this is an economy that forgot how to grow. And in this economy, we expect any period of what looks to be strength to be followed immediately by giving it all right back. That's absolutely the case in retail sales. And as we'll see, it is especially the case in industrial production, which is, of course, derived from retail sales and retail spending. The forgot how to grow economy begins and in many places, in many ways, ends with consumers. But they say it's fires in LA, the tragic fires out there, the extreme cold, even though it's always cold in January. Here's what CNN said. American shoppers pulled back on their spending last month for the first time since August as stubborn inflation continued to bite and it's really lost purchasing power, and the lack of income growth and the lack of job opportunities. Come back to CNN. And harsh weather curbed economic activity, as if Americans don't know how to navigate snowstorms. Well, the government's retail figures are adjusted for seasonality, which means that they should know that this is their winter cold. Unusually cold weather in recent years has had an outsized impact on people's spending behavior, typically in January. And it's not the winter, it's the fact that the economy isn't as robust as people make it out to be. A key measure that excludes volatile components, referred to as the control group, was down 0.8% in January. Spending at restaurants, bars, and department stores, however, remained in positive territory. So why did bars and restaurants and department stores, why were they able to see positive sales growth if the weather was so bad? If it's so cold and snowy, then how did Americans get to bars and restaurants and department stores? If it doesn't make sense to you, that's because it really doesn't make sense. It's really just an excuse to say, we don't really know why January always seems to be bad, because that would mean that the overall economy that we tell you is strong and robust, maybe it actually isn't strong and robust. And then Americans really struggle after the Christmas season because, again, they're generous. They like to buy. Yes, there's consumerism, but they like to buy stuff at the end of the year. But then realizing that they have to pay for it and a whole bunch of other things, auto insurance premiums, heating bills, at the start of the next year, it just makes for this back and forth toxic mix, the economy that forgot how to grow. The economy that forgot how to grow is a topic they cover quite extensively in all the different facets of it at Eurodollar University's Deep Dive Analysis. For the next couple days, just through Tuesday, we're having a short-run President's Day sale on the Deep Dive Analysis, on Eurodollar University memberships, and the daily briefing, especially when you bundle them all together. One really incredibly low price just for the next couple of days. Check out Eurodollar.university for all the information on our subscriptions as well as these sale prices. Next couple days only. We can't forget the overall labor market conditions as well, because Americans sure don't. I've talked about the FRB&Y Survey of Consumer Expectations, and it really starts with the labor market condition. While the media says the labor market is strong and resilient because Jay Powell does, American consumers as workers know the difference. There's nobody hiring. Hours are being cut. We saw that even in the establishment survey. JOLT's hiring rate is down in recession territory. Quitting rates, which suggests that Americans know that the labor market is not robust. So, of course, there's going to be an impact on spending. They want to spend during Christmas, but then they have to pay for it. And they pay for it by foregoing spending in the early part of the following year. And that's exactly what we see yet again. And every time we see this, we know it's more of the same, forgot how to grow. Or really, this goes back to the silent depression in the 2010s. We saw the same thing. It's not cold winters. Everybody knows about cold winters. It's not about these one-off excuses. It's about the economics behind it. Besides, analysts were expecting retail sales to only moderate a little bit in January, knowing that the winter weather was really wintry last month, knowing that there was tragic fires, massive fires in Southern California, and yet they expected retail sales to only decline by 0.1%, maybe 0.2%. And instead, it came in down 0.9%, far weaker than analysts were expecting because it's not about winter nor fires. The actual data from the Census Bureau showed minus 0.88% month over month in January, which is the first negative since August. Last January, again, we saw the same thing, minus 0.73% month over month. In fact, the 0.88% is the worst since the early part of 2023. And this is very different from the January of 2023, which despite cold weather, despite the holiday hangover, the difference in January 2023 was cost of living increases, especially through Social Security, and wage gains and job gains that have not happened last year nor again this year. Spending is down because incomes are not like they were at the start of 2023. That's how you know the incomes are off to a rough start to the year, because spending didn't follow along like it did in early that year, 2023. And everything is worse in real terms. As bad as that minus 0.88% is in nominal terms, in real terms, retail sales fell by 1.34%. And that basically wipes out all of the holiday gains, putting real retail sales as low as they were back in August. So for all the purported strength in buying, real retail sales are now well below the pre-pandemic trend line, the 2010s trend line, which was not actually a strong one. Americans are paying more to get less than they would in an actual full recovery, which is another big problem too. Auto sales down nearly 3% in January in nominal terms. That was after a big increase, almost 2%, more than 2% in October, a 3% increase in November, and almost a full percent increase in December. So what that suggests, giving that back in January, is that not all of that buying was because of purely interest rates or the perceptions that rates were going down, that most consumers, they get their view on interest rates from whatever the Federal Reserve is doing. So as soon as the Fed cut, they believed that interest rates were falling when market rates had been falling long before then. But either way, if it was just about interest rates and the perception of the Fed cutting rates and making them go lower, then you would expect auto sales to continue to rise in January. Instead, we see the give back there, a pretty sharp one, suggests that a lot of retail activity in buying autos, combination of lower interest rates plus knowing that if there are tariffs placed on imported, especially cars, those prices are going to go way up. So once again, we see an artificial factor that may have pulled forward a ton of demand into the end of last year, leaving the overall economy to have to pay for it in a variety of ways at the start of this year, starting with retail spending. Retail spending overall and retail spending on cars. Even ex-autos. Analysts were expecting ex-autos, despite the winter, despite the fires, despite all of the excuses. The consensus was that excluding auto sales, retail sales would rise 0.3% in January, and instead, excluding autos, they were down 0.4%. Not only is that a big miss, it's a complete miss in terms of sign. They're aware of the winter weather, aware of all of the other one-off factors, except for the economics. And the economics includes the one-off factors I'm talking about: heating bills, auto insurance, and most of all, those things combined with a less than robust actual jobs market. And if Americans aren't spending on goods, that means that American producers are not going to be producing a lot of goods. In fact, industrial production, like Germany's GDP, the best American example of the forgot how to grow economy, that doesn't look like a recession, at least not the traditional recession most people are aware of, but it has reached the proportions of a very serious and sharp recession. It's trending completely sideways to slightly lower. So again, it doesn't look like the traditional recession, but going on 2.5 years now, almost 3 years, that's an absolutely enormous contraction. In absolute terms, it's not a lot, but compared to the trend, which is what everything really should be compared to, U.S. industrial production, and this is a volume statistic, by the way. This is not even bothered by price changes or the price illusion. The industrial production, the level of actual output in the U.S. industrial economy is some 13% below where it should be and where it really needs to be for a healthy, robust economy. In fact, that's not even healthy and robust. That would just be the minimum level for something like a recovery. A real healthy economy is so far away we can't even see it at this point. But again, industrial production is a good example of forgot how to grow and the misinterpretation of the forgot how to grow economy. It doesn't look like a recession, therefore everything must be fine, when everything is not fine. And you can see it right here in this particular statistic. For the month of January, however, it did rise by 0.5% because of an enormous 7.2% month-over-month increase in utility output. And that followed an almost 3% increase in utility output in December. So IP is rebounding here December and January based on, guess what, the weather. They're actually right about that. But in this case, the weather didn't harm. It helped at least industrial output. Now, it's going to harm the consumer economy as American consumers have to pay for the heating bills from all the cold weather that's represented by the 10% increase in utility output over the last couple months. But outside of that distortion, weather-related distortion, manufacturing output actually retreated again in January, down by 0.15%. That was after 2 monthly gains in November and December. And it had been down 2 months before that by a combined 1%. So again, you see the back and forth. Every time manufacturing output or industrial output overall puts in a couple good months, they give it right back all over again. And the end result is The manufacturing output, manufacturing sector, industry overall, the goods economy, it goes nowhere. It ends up going nowhere, which is, again, a massive contraction. Especially the longer it goes nowhere, the worse it actually is. So as far as the industrial statistics here, the Fed's numbers, they're not picking up a recovery in the goods economy at all, which means that a lot of people are overreading and overestimating what the ISM and S&P Global's PMIs for the manufacturing sector are really saying. There is no real pickup in industry. It's more so just the same back and forth, these fluctuations that don't really change the trend. And the trend is forgot how to grow. And it's, of course, even worse than forgot how to grow when we talk about motor vehicles and autos, the one that's late to the cyclical downturn party. Latest data for January from industrial production on motor vehicle assemblies shows a seasonally adjusted annual rate of just 9.38 million. Not only is that down from a 10.16 million in December, that's the weakest since July, and it's actually as bad as October 2023 when the UAW went on strike, which that was a 9.37 million seasonally adjusted annual rate. So automakers, car makers, they're not buying any pickup in demand. They're seeing it at best as artificial, as I was describing it. So any increase in sales that did come up last year, that just came out of inventory, leaving, as I mentioned in a previous video, leaving inventory still to be way too much, way too high. So automakers, they're not seeing anything changing as far as the overall auto economy and consumer economy, regardless of interest rates or anything else. Instead, they're looking at what's happening in the overall big picture and thinking, we still have way too many cars left over from last year, so we're going to have to lower production, which means, as we're seeing in a lot of automakers around the world, Nissan, the European manufacturers, especially the German ones, they're cutting and laying off workers. Stellantis. In fact, that's exactly what the establishment survey showed, the BLS data for the month up to the month of January. As far as the BLS is concerned, in the establishment survey, we see pretty substantial job losses in the motor vehicle industry. And as the car business, a key cyclical warning, continues to struggle like this, and it's going to get worse as this year progresses, as the car business continues to struggle, there's going to be a whole lot more that does downstream and upstream from that. Upstream from that, you've got all the suppliers, raw materials, a whole bunch more beside. The car industry is not like it used to be. It doesn't dominate the economic landscape as it once did a couple generations ago, but it is still an important economic sector nonetheless. So Amazon last week said headwinds on the U.S. and global economy entering 2025. Then the Census Bureau comes out with retail sales that show, yes, headwinds in 2025. In fact, we've seen this pattern too many times before, including the fact that the media wants to dismiss it as a combination of one-off factors that you shouldn't be concerned about. But what you should be concerned about, what the media always dismisses, and because the central bankers do and economists do, is that this back and forth, it's the same recession trend, the same forgot how to grow trend, if you don't like the term recession, it's the same trend regardless. Every time things look like they're picking up, they suffer a setback in relatively short order. Retail sales is no different. Industrial production, manufacturing production, the same exact thing. And the upshot of which, what happens? The overall economy goes nowhere. But going nowhere doesn't mean you're avoiding recession. It actually means you're in one that doesn't look like what everyone thinks it should look like. But it doesn't matter what everyone thinks. The fact that the economy's going nowhere, forgot how to grow, and all the data that we get just continues to confirm as much, shows we aren't suddenly, the global economy, the U.S. economy didn't suddenly remember over the last couple months of last year. And it starts out, as Amazon said, this year on the wrong foot. Talked about the auto business and a whole bunch of stuff related to the auto business, not to mention consumer sentiment rolling over, fitting perfectly with everything we talked about here. That's all in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.